Welcome to Nasdaq Trade Talks. I'm Jill Malandrino, global markets reporter at Nasdaq. Joining me at the MarketSite studio, we have Phil Mackintosh, chief economist at Nasdaq, to discuss the sudden rise in rates and also what's happening in the housing market. Phil, it's great to see you as always. Welcome back to Trade Talks. And we've seen the market dial it back a bit, since mid-July, although today is a different story, of course. And it really has to do with rates. They've moved up quite significantly.
Yeah, I mean, everyone's talking about the negative markets last week and the China story that came with it. But if you actually look at a little bit of a longer window, since mid-July, we've actually had the 10-year increasing slowly but really consistently. And it's actually up almost 60 basis points, more than 0.5% on a 10-year bond, which is theoretically the average rate we're expecting to see for the next 10 years. So 0.5% is a big change in a 10-year in a relatively short period of time.
So the obvious question is, what's pushing up rates so frequently?
Yeah, it's a lot of relatively strong news. We see retail spending being pretty strong. We see employment still being pretty strong. It just gives the whole market and Fed as well justification to keep those rates higher for longer. And that's actually what we're seeing in the curve as well. We haven't seen people really forecasting like another 50 basis point hike imminently, but we are starting to see the long end of the curve, which is the 10-year rates, starting to edge up, meaning we're not going to have rate cuts as quickly as we were thinking maybe 2 or 3 months ago.
Well, of course, this is moving mortgage rates up as much. I mean, you're basically getting less house for it was costing a lot more money.
Yeah, I mean, mortgage rates are one of the rates that obviously are long-term as well, and they're at multi-decade highs now, which kind of snuck up on a few people. And to your point, if you look back a few months ago, you could bought with a $2,500 amount of money, you could have bought a $700,000 house. Now it's about a $450,000 house. So it's having a big impact on people looking to buy new houses, because what they can afford with the same amount of money has definitely come down.
Right. Well, of course, you have to factor in taxes and insurance and utilities and landscaping, all the good stuff that comes along with it. So the question is, why are home prices holding up?
Yeah, it's interesting, right? So it's a combination of the fact that because a lot of people have actually locked those low mortgage rates in 2 or 3 years ago, they can't really move now, because if they move to a new house, they're going to give up that low mortgage rate and reset to this new multi-decade high mortgage rate. So we've actually got a lack of people wanting to sell. Which kind of matches the lack of houses that people want to buy, because people can't afford to buy houses because of the high interest rates. So what we are seeing, if you look at the data in more detail, people are buying new houses, but the secondary market, the existing houses, are just not selling because people have locked in those mortgage rates and they're not moving. I think the good thing, though, from the economy's perspective, is people that have locked in those low mortgage rates aren't actually affected by the interest rates increasing in the last few months. Their mortgage is the same regardless of what happens in the next year or so to mortgage rates. So the spending that they can do and afford is relatively unaffected. It's not like 2007 when a whole lot of mortgages reset and people suddenly had to double the payments and they didn't have enough money left for all those things you just mentioned.
Yeah, well, I'm going to pull up the chart that we just had up here before. When you take a look at affordability, I mean, this is, since 1985, it's the worst in terms of affordability.
Yeah, it's even worse than just before we went into that housing crisis, which was the credit crisis.
Right.
So because, I mean, wages have gone up a little bit, but because interest rates have gone up a lot to multi-decade highs, and because you've got the housing prices really high as well, the actual affordability of houses, the amount of money of your salary you have to spend on housing, is worse than in 2007.
Well, and the other thing is, too, if rates come down and then there's more supply back on the market for folks who bought their homes now at high interest rates, if their house value comes down and declines, then they're also not getting any equity on their homes.
And that's kind of what happened in 2007, wasn't
Right.
it? Where suddenly people were forced to sell because they couldn't afford, but the equity was lower, and so there was a whole lot of losses sort of washed across the system. People's balance sheets were weakened. At the moment, because everybody's locked on those 30-year rates, actually household balance sheets are looking pretty good. Even if you look at credit card usage, it's creeping up, delinquencies are creeping up, but it's nowhere near 2007 levels.
All right, Phil, appreciate the insight as always. Thanks for joining us on Trade Talks, and thanks for joining me. I'm Jill Malandrino, global markets reporter at Nasdaq.